Good afternoon, Quasar Markets Live, and good afternoon, Dr. Alan Ellman. How are you doing today, Dr. Ellman?
Wonderful, Howard. Good to see you again.
Good to see you. Love that we get joined by you every Monday to break down some more in the world of covered calls, cash secured puts, investing in general, and giving your 30 some odd years of expertise to our viewers. That is so important to what we're trying to do at Quasar. So, again, I thank you like always.
Sure. Actually, today, the market plummeting the way it has, this is particularly an appropriate discussion, the $0 collar, to protect stocks that have appreciated in value against catastrophic loss to the downside. So, this is really a good topic for today.
Absolutely. Markets continue to slide away here today. You know, Nasdaq's retreating, everything's retreating. So this is a perfect segment into it. I didn't do it because of that. I really did it because I think that this is a technique. And one of the things that I read about in your exit strategies, using some of these techniques to change your positions that I thought were so helpful for me. So I thought others could learn from them.
Yeah. Covered calls and puts can be used in so many different ways. I mean, a lot of people think, particularly beginning retail investors, that you just buy a stock, sell a slightly out of the money call option, and then of course pray for a happy outcome. But it can be the strategies can be crafted to be bullish, to be conservative, to be defensive, and also they can be crafted as protective measures in our portfolios, as with this discussion of the $0 collar, which basically is an insurance policy on appreciating stocks that we don't have to pay for.
Right.
So we're going to talk about how to protect those stocks. And the example you asked me to speak about is one actually that I published about, I don't know, maybe 8 or 9 years ago, but it is a great example of this on a stock that actually doubled in price over the course of a year. And for those that have a stock like this, they may feel like, you know what? I think it still has legs to the upside, but I'd sure like to have that protection of all that appreciation. So, of
Right.
course, you could buy a protective put as insurance, but you have to pay for that. What if you don't want to pay for it? Well, the $0 collar is a solution to getting that protection and not having to pay for it.
Absolutely. And we were talking before we came on is I know it doesn't fit into the low cost. Well, it does because they were lower cost at that time, but the Nvidias of the world, the Apples of the world, we're seeing this across so many different, widely held stocks right now, especially in the market, right? I think a lot of us have stocks that are definitely that we bought at very low prices that made those giant moves up. And especially when it comes into those AI names, those crypto based, companies or that tech names and even chips and even the lead Mag 7 could have some, opportunity for all of them right now.
Yeah, well, before we came on, I took a look at the Qs, which is an exchange traded fund based on the 100 largest non-financial companies listed on NASDAQ. And they have the Mag 7 in there. And that was down $15 a share before I came on. That was a huge drop.
Yeah.
And so if you had a $0 collar on that particular security, you wouldn't be down in the dumps. You'd be losing a little bit, but negligible amount if you had this kind of a trade in place.
Right. So
So
this you're going to break down here how what is it and how does it actually get put together?
okay, so what a collar is, and we probably alluded to this. This is, I think, my 20th discussion with you. I believe at some point we did speak about the collar. So the collar basically is a three-stage trade. It's a covered call, so you buy the stock, and then you sell an out-of-the-money call option, agreeing to sell the shares at a price higher than current market value. So on the image that is on this particular slide, the out-of-the-money covered call would be where you see ceiling on the top right. In other
Yep.
words, if the price of that security goes beyond the strike price of the covered call, we, as the share owners, do not benefit any place beyond that. But it can go up from the current price, which is that blue line, up to the higher orange line. So we have opportunity for share appreciation. Now,
Yep.
when we buy a protective put, an out of the money put, which means lower than current market value, which is shown on the lower left part of the screenshot, that creates a floor. So if the price of that security goes down much, much further than that out of the money put strike, below where you're circling it now, we don't lose any additional money. So we have a certain amount that we could lose and a certain amount that we can gain, but it's defined. It's a defined risk trade.
Right.
So the put that we're buying to protect that stock costs us money, but the covered call aspect of it will generate a premium. So when we're doing a collar trade, a $0 collar in particular, our goal is not to have any catastrophic share loss on this appreciated stock, and also to allow for some amount of continued appreciation from the blue line up to the higher orange line, and also not to have to pay for that protection. And that's the
Right.
whole, those are the three goals when we're doing a $0 collar.
Absolutely.
So I have to say that when we say $0 collar, that means you're expecting to pay actually zero. And it doesn't always work out like that,
Right.
although it does in the particular example that you asked me to talk about. It's
Yep.
exactly zero, but that's an aberration. Usually it's a very, very tiny debit that you have to pay, or you'll get a very tiny credit because the put and the call premiums won't always be precisely the same. So what you're going to see today is a little bit of an aberration, but basically we're talking about either no cost or a slight cost or a slight credit.
And I
And
will point out that you did do a session that actually explained that with us, where we talked about the difference of the at the money puts and calls and why there is a difference there.
yeah, we talked about it at a previous discussion. But I just want your viewers to understand that even though you're going to see today a real zero net situation here with no credit or debit, usually there's a little bit one
Right.
way or another. It really doesn't make a difference because you're going to be achieving basically all three goals.
Right. It's
Uh,
very minimal. It's a minimal amount compared to the
yeah,
cost of the underlying.
right. So here's the chart of Helen of Troy listed on NASDAQ. HELE is ticker. And you asked me to speak about this. It is a very interesting trade because you see from the year 2016, you could see that Helen of Troy doubled in value.
Yeah.
So it went up from in the 50s to over 100. So you see initially up through July, beginning of July, it was like a rocket ship heading to the moon on a 45-degree angle. And then there was a gap down at the very beginning of July where you see the separation of the lines kind of in the middle right of the chart there. And then you see right there, I don't know if your cursor is right there, right
Oh,
there.
yeah. Hold on one second. Let me get back to my pen here.
Okay. So that was an earnings report, and it disappointed slightly. It went down. Then it went into a consolidation where it moved sideways for a while, and then
Yep.
you'll see all the way to the top right of the chart, you'll see a gap up, another earnings report. And we've talked about earnings reports many, many times in our discussions and how it creates a risk to the trade. And this is a great example, actually, not only of the $0 collar, but also of the risk and earnings reports and why you should
Sure.
never have an option in place when there's an upcoming earnings report. But overall, Helen of Troy doubled in 2016. So you might say to yourself, okay, look, I doubled my money. I think
Yep.
it still has legs to go higher, but I sure would like a way to protect all that cash. It's unrealized at this point in time because I haven't sold it, but I would sure love to protect it to make sure I keep the lion's share of that unrealized profit.
Yep.
Enter the $0 collar. And that this is a perfect example of it. So here we have the option chain now. At that time that I made this screenshot, you could see on the left side of the screenshot, is the call option chain. Keep in mind that the stock was trading at 103.19, and this is for a 5-week expiration. So when we do our calculations, whatever the credit is, percentile, if you wanted to annualize it, you could just multiply by 10. But,
Yeah.
of course, we have our trade management calculator that will do all that for us.
Absolutely.
So when we look at the option chain, Howard, you'll see that in the bid column for the calls on the left side, it's $2.55 is what you would generate from writing a covered call for that 105 out of the money call strike. Helen of Troy is trading at 103.19, so that gives us a potential share appreciation of $1.81 per share for that 5-week period. Now, I just want you to notice one thing here, that the bid-ask spread, it's a little light on my screen, looks like it's 255 to 285.
Yep.
So we actually could do better than 255 by negotiating with the market makers, leveraging what's called the show or fill rule. That's in my material, in my books and everything. It's something that all retail investors should know how to do, because
Absolutely.
spread of 30 cents. Actually, I do it whenever it's more than 10 cents. Then we have negotiating leverage thanks to the SEC with its show or fill rule. So you'll put a limit order in between the bid and the ask, favoring the bid slightly, but maybe that's a discussion for another day. But
I just wrote it down. We'll definitely do a session on show and fill. I already wrote it down, sir.
Okay. Great. Because that's important, because when we talk about that,
yeah, you don't want to leave those pennies on the floor. I mean, they're right there for you to get. You don't want to just take it at their. It took me a long time to be taught that. Unfortunately, in the world of crypto, I was buying at market all over the place when I shouldn't have been.
Well, when your viewers watch that discussion, it's immediately going to put money in their pockets immediately.
Yeah, absolutely.
So that's a no-lose discussion for whatever date you decide. But now let's look over to the right side of the screenshot, and that's a put option chain. So here again, when you buy a put, you buy at the ask. So when you sell at the bid, the lower, and when you buy at the ask, the higher. So here the ask is 255. Notice the bid is 205. So we have a spread of 50 cents. We definitely can negotiate that.
You'd be negotiating.
We definitely negotiate that. But in any case, we're going to use 255, the worst case scenario, the published ask price. So you'll notice that, ironically, with this example you asked me to talk about, that it's a true $0 collar.
Right. And that's why, even though this is older, it still pertains, and it's just easier. People sometimes get too caught on that 35 cents or 10 cents here, and I didn't want them to get lost in the discussion. That's why I look back for one that you had that used a true zero as it, because I think it makes it just an easier discussion for sure.
Yeah, it's a great example. These discussions like this one are almost like a math equation, because
it is a math.
Apply it in a million different scenarios.
Yep.
And so, whether it's Helen of Troy or something else, some other appreciated stock, the same principles would apply. So if you know how to do one, then you really can know how to do them all.
Absolutely. Anything that you're in a tremendous profit in, but want to hold those shares while protecting it. We see it all the time. I have people that are in NVIDIA, that are in Apple, they're in Bitcoin, that ask me these questions. This is a great way to do it and get that protection.
How many people that are watching this presentation now would be saying to themselves, gee, I wish I had one of these in place for NVIDIA or for the Q, or for anything technology related, as the market is just plummeting from these tariffs and the uncertainty and the chaos that's going on in the market these days.
Absolutely. So now we're going to talk about the goals that you're trying to achieve, or what they are, sort of the where we win, where we lose. Well, you don't really win, but where we maximize our our savings here, and where it kind of goes out of the money.
Well, earlier in the discussion, we said that when you're doing the $0 collar, you basically have three goals in mind. The main goal is to protect these appreciated shares from losing all of this unrealized profit. So when you have that out of the money put in place, in this case, the $100 strike, yes, we are protected, because even though it can drop from 103 to 100, that would be losing $3 a share. That's nothing to break open the champagne on, but at least you have that protection that if it goes to 50, you're going to still get 100. So it does give you that downside protection, which was the main goal number one.
Yep.
Goal number two is, even though you're getting this protection, you still want to allow the underlying security, which has gone up so much, to go up some more. Otherwise, if you're not going to allow it to go up some more, you might as well just sell it and take your profit, right? So in this particular case, yes, that goal is met too, because we're allowing Helen of Troy to go from current market value of 103.19 up to, but not beyond, remember that's the ceiling now, at 105. So if you do the math, it calculates to a 5-week return of 1.75%, which annualizes out to over 18%. So that's significant also, even though it's capped. If you annualize it out, it's still a very, very significant return. And we have that downside protection on top of that. So that's goal number two is met. Now, goal number three is we want to make this a no cost or low cost collar trade. And here, of course, we had that unusual scenario where it came out to the penny. But again, it might be a few pennies the other way, or it might even be a credit of a few pennies. That doesn't matter. The point is that you're getting this protection at no cost, low cost, or a slight credit, and you're accomplishing at the same time your other two goals of downside protection and then allowing the shares to appreciate a little bit more. But when you annualize it out, you find out, you know what, that's pretty significant.
Still a significant change. Yep, absolutely.
I mean, if your bank offered a CD at 18%, wouldn't the line be around the block about 25?
Yeah, we would be jumping in very quickly, very quickly. To do that, you have to go to countries that have very, very big fluctuations in their, value, like a peso or something there. And even a peso is only a 10% interest earning account.
Yeah. So, I mean, when you look at the option chain, you go, oh, wow, it only allows you to go up to 105. What if the stock goes to 110? There's always a trade-off.
Absolutely.
When you want to generate premium from covered calls, you're capping the upside. If you want to buy a protective put to protect against catastrophic share loss, well, it's going to cost you some money. And so the $0 collar kind of negates the fact that you're paying for it at the cost of, well, you know what, it's going to cost me some money. That'll be negated by the out of the money call, but there will be a ceiling and a floor. Good news, bad news on the ceiling, good news on the floor.
Right. So, absolutely. Yeah, there is, like we've talked about with that, all of the strategies that you have, nothing is 100% of the time. If it was, none of us would be working anymore. We would just constantly do that. If you want no risk, and that's not even no risk, you got to buy a treasury bond, and then you're losing to the money printers as they go burr.
Yeah, that's true. And I know I've shown one of my favorite slides, which is the risk reward spectrum.
Yeah, absolutely.
And I show it now at probably all my presentations, be they by Zoom or live presentations. I'm heading off to Dallas in a couple of weeks, and then I'm going to Miami and Orlando. I have a lot of live presentations that I've accepted for this year. And I plan to use that risk reward spectrum slide in all of them, because too often retail investors are told that they could make a ton of money in a short period of time for very little time and effort, very little income outlay. And that's just not the case. You could definitely make money in the market with stocks, with options, absolutely. But you have to determine the amount of risk that you're willing to take, and that will allow you to generate a higher outcome. But you also could lose more money with those higher implied volatility trades. It's very important that your viewers understand that, because there's no free lunch out there. And
No,
so,
and that's why we try to bring so many different educators here to everyone at Quasar Markets, because there are so many strategies and there are so many risk tolerances that people have. We want to bring from the very conservative to, to the more aggressive. We're not gamblers, so to speak. We don't like zero DTEs very much. We don't talk too much about that stuff. And then in the world of meme coins and meme stocks, we're not really big players in that world. But, that's why, and like you said, there are multiple videos where you've brought out the risk reward and shown, because what I try to explain to people is sometimes when I get someone that comes to me and asks about less risky trades and I say, hey, you really should check out BCI and what they've got, they hear the word options and they get so nervous because they've got the zero DTE option in their head, maybe, or they've had a limited, naked put, naked call experience. So I do want to stress to our viewers the procedures and strategies that Dr. Elliman and the BCI, which is the Blue Collar Investor, put together are based to be even more conservative than just buying outright a stock, right?
Yeah, when you write a covered call or buy or sell an out of the money cash secured put, your break even price point is lower than if you just outright bought the stock. So because you're lowering your break even price point, you're gonna set yourself up where you have the potential to beat the market on a consistent basis. Something I've done now every single year for almost 30 years. I started in the mid 1990s teaching myself these strategies. Some years I beat the market by just a little bit, and some years and many years I beat the market significantly. And I'm way better at this now than I was in the mid 1990s, because I made all the mistakes that you can make and I fixed it. So I
Right.
made
No,
sure.
you joke, but we've talked about this in the past. One of the things that I have been so impressed with, and I do think that separates you from a lot of educators, is that you do analyze the wins, the losses, all of them, to see what you maybe could have done differently that would have brought a little bit more profitability, or was there a way you could have mitigated a loss and made it a win? And that's so important, and it's how your system is always constantly evolving, right?
Yeah, I mean it's different today than it was back in the mid 90s. I started sharing this publicly in 2007 when I started changing careers back then. So the first decade or so, I was just doing it for me and my family, and then I started sharing this information publicly. And then any time that I found something that would enhance the protocol, I did it. I'm not afraid to change it, even
Right.
today. If somebody gives me an idea, if I figure out, or someone on my team figures out something that would make an improvement even more than what we have now, I'm okay with that. I mean, I'm not saying that everything we're doing now is the best that it could ever be, but as time has gone on and we've made these adjustments more and more, we've made changes less and less because they haven't been
Right.
needed. But
Right. Well, exactly. You've now lived through the ups and downs of the markets, whether it had been COVID or the 2008 financial crisis or the dot-com bubble was a little before you started doing it. You were doing it yourself at that point.
yeah,
But, when you live through those ups and downs, I've talked about it when it comes to Bitcoin. I get less impressed by a 10% loss every day. You know what I mean? It's you just start to learn, get better feels for things. You sort of live through the wars, right? And we learn from them, and that's why you've traded through some of the great upsides like we had in COVID, right? We never saw a stock market over a 2-year period move in a way that it moved there. And then we've seen it on the other side going into COVID. So that's what's important, is to find educators too that have been doing this not just for the last 6 weeks or 6 months, but years and years of experience, like you have, and so many of the folks that help us at Quasar. So we talked a little bit about this already, but if you wanted to elaborate maybe a little bit more on what a show or fill rule is.
there's an SEC regulation called the show or fill rule, and what it says is that if you place a limit order uh, that improves the market, which means anywhere between the bid and the ask. So if the bid is, let's say, 250 and the ask is $3, so if you put in a limit order somewhere between 250 and $3, that's considered improving the market. So if you put that in, now the market maker gets this limit order in and has to make a decision. They're forced to either execute that trade and give us what we wanted, or publish that new bid price that we just put in. Let me give you an example so you view this will help crystallize it for your viewers, I hope. So let's say $2.50 to $3. Now, what you first thing you do is you find the mark of that bid-ask spread. The mark is just another way of saying the midpoint.
Right.
So if the midpoint between $2.50 and $3 is $2.75. Now, what I do when I'm selling on the sell side is I will favor the market maker by a little bit. So I won't put in 275. I'll put in 270. So I'm favoring the market maker a little bit. Now the market maker gets this limit order in from me, and they have to make a decision. Am I going to give Alan his contracts? Maybe I'm doing 3 to 8 contracts at 270 just to get rid of them. Or am I willing to make the new bid-ask spread 250 to 270? Now, these guys make their money on the spread. So the larger the spread, the happier they are. So what they'll do in many, many cases is that just to get rid of me, okay, I'll give Alan his 270, get rid of him, and then I can keep the spread published at 250 to $3. So you'll be surprised. I know you won't be, but many of your viewers will be surprised how often you'll get that extra 20 cents. $20 a contract, that's dinner on the weekend if you get
it adds up very, very, very quickly. And like you said, you see a lot of fills in that sort of dark gray area in between them. As you mentioned, it's a big market. And just to elaborate a little bit more, what the market maker is hoping is to balance the books. It's almost like a sports book used to be, right? They wanted half the people on one side, half the people on the other, and they were happy to take that 10% or 5% vig or juice on the bet. And with the spread is that extra money, if they can get it on their side, again, they just win every single time. So it's a way for us to sort of battle back.
Whether we win or lose, right?
Yeah.
But one more thing that just hit me, and I just want to make sure I get this in for your viewers. If your viewers are going to implement this show or fill rule into their trading strategy, some brokers have a box on their trade form that says AON or all or none on it. Do not check that box.
Right.
If they check that box, then the market maker is no longer beholden to the show or fill rule, and they could just say no and not publish your 270. So not all of them have it. I believe some still do. Just don't check the box. That's all.
Absolutely. So what would, and you've spoken a little bit about this, but what are the downfalls or the disadvantages a little bit that you could have from the $0 collar?
Well, I mean, the disadvantage of the $0 collar is that your upside is limited. Now that applies really to any covered call trade. You're putting a limit on so the good news is you're lowering your break-even price point, right? You're generating cash flow. And the bad news is you're limiting the upside of that trade. However, if you're establishing a trade where, let's say, your goal is to have an initial time value return of, let's say, 2 to 4% a month, you can accomplish that. That's your starting point. You're lowering your break-even price point, and now from there you could end up with your 2 to 4%. You can end up higher if share price moves up. Or you can end, if it drops below the break even, you could start losing, which is where your position management skill set would come into play. So one disadvantage is you're capped on the upside. And again, that applies to any trade that falls under the category of covered call writing. Now, also your premium is reduced. You have to pay for the put, but then again, your goal here with the $0 collar is more retaining that share appreciation that you don't have yet because you haven't sold the shares. So it's unrealized at that point in time. So you have a different goal really, but you're still allowing some appreciation. So I'm gonna shut that. And so that's one disadvantage. And but we are protected against catastrophic share loss. So the main disadvantage is the capping the upside, the cost of the protective put, but overall, this will give you what your three goals are if you're
Sure.
looking to protect an appreciated stock.
And again, like we said, that you wouldn't be, at least I would not be using this in a bullish market overall. If my general sentiment of the market was bullish, this isn't something that I might use. Maybe I do if I'm worried about a blow off top coming over, that we're at the top of the the very end of a bullish one and it's turning over. But in a bearish market, it definitely comes more into play on a regular basis than we see, especially when the bear market follows a 24, 48 month bull market.
Yeah, I mean, that, and also if your goal is, you've made so much money on this stock, you've made so much money, my goal is to protect it. Now,
Yeah.
you can go ahead and just buy a protective put, and not cap it with a covered call. You could do that,
But now
but
you're not getting rent, you're paying rent, right?
you're paying. And so if you don't want to pay, then this is a way to circumvent that. So you bring in a great point, Howard. Everything, how you set up your portfolios and your strategy depends on what your goal or goals are, and they'll vary. When you say in a bull market, well, that implies that you're looking to get as much share appreciation
Right.
to the upside as possible. Well, then you're not going to cap it with a covered call,
Yep.
right?
Absolutely.
And you may not even want to do a protective put if you have confidence that the market is going to continue to climb. But yeah, so you have to establish, what are my goals? Once you've established your goals and you know how to do it, depending on what those goals are, then that will dictate how you set up your trades, period.
And it will, and again, it can change within your portfolio. I think sometimes people think that I have to do something for everything in my portfolio. You don't. It might just be, maybe you have Nvidia and you have Bitcoin and you have, Palantir that's gone through the roof. And maybe you're confident that the chip factor might come back quicker, but you're worried about, Bitcoin because you don't know what's going on. We just should have had all this good news that moved and it didn't. So maybe Bitcoin you do this with, and with Nvidia, you allow it now. You say, I think it's going to run, so I wanted to do that. Keep in mind that it can be played in any different sort of percentage of your portfolio, right?
Exactly. One great example is one of your favorite ETFs, IBIT.
Yeah.
There was a time when the market was more stable that I was a very small portion of my portfolio. I was buying it and selling out of the money covered calls, allowing for additional share appreciation. But since this market turmoil has hit us, I've been using it only with deep out of the money cash secured puts.
Right.
And I'm generating a pretty decent weekly return. For example, last week, I don't remember the strike I used, but the out of the money put that it was set up did expire out of the money, even though it declined in value. And I'm going to do the same thing when we get off this call. I'm going to sell a deep out of the money cash secured put. You could generate pretty significant weekly returns. And of course, you hope that it doesn't drop below that deep out of the money put strike. But again, the odds are in our favor, especially since it already dropped a lot today. So, that.
Right. And that's why, exactly. This would be a good time to look at it. It's something I'll probably do too, because I'm looking at an entry price on Bitcoin that it's not there yet. So using your technique, like you're talking about, I can get paid to wait and be patient. And if it hits the spot, I won't be upset to get a fill there, because my long-term thesis starts with a liquidity zone that I'm looking at here right now. In that 73,000 range on Bitcoin. So I can equate that into where IBIT would be, and definitely use that, and probably will. So I always appreciate that. Why don't you take us home here, Dr. Ellman?
Okay. Well, again, I feel like your viewers should understand that the $0 collar is not for every trade. This is an unusual situation where you would use it to protect shares that have appreciated dramatically in whatever period of time. In this case, it was a 1 year period, and you just want to protect that unrealized profit. So I would say this: it's not a trade that you would make consistently in your portfolio, but in certain specific scenarios where you've made all this money and you just want to make sure that you retain it, there isn't a drop down. And you saw on this chart what can happen to a stock during an earnings report. So if you're going to hold it in your portfolio, you might even want to put it in place, at least to
For an
protect
earnings.
the put part, right before an earnings report. So it can be used in many different scenarios, but in this one, it's to make sure that you retain most or all of that unrealized profit over time. And so,
Absolutely.
it's got its application, but it's not a general scenario that you would use all the
Right.
time.
Right. Not one that you put across your entire portfolio on every given day or every given week. Something though, if you think that volatility is stepping in, if you think that, things are only going to move in a more downward spring here before we get any kind of move to the upside. We heard the recession word being used a lot. We even heard our president mention it, right? So if you feel that recession's on the horizon, then this would be a way to protect your portfolio for that.
Yeah,
Dr. Ellman, thank you so much for joining us. I already know next week we're going to talk about show and fill, or show or fill, and we'll go with that as a great topic. So thank you so much, like always.
I always enjoyed these discussions, Howard. Thank you.